Bukuru cannot hear. Members, are you hearing me? I hear Bukuru saying it is not hearing.
We hear you.
Okay. So Bukuru, check your microphone. Maybe you didn't switch it on. So that is where we stopped. Any question before we look at this example and then move on to another part? So if you don't have a question, maybe we can look at this question. There are 4 questions that I've put down here, but maybe we can look at one. So this is the question of December 2021. 2021 question 3 August. But let's see, ensure that we always enter on time, because it becomes really disturbing every time you are allowing students. So let's look at this. The shareholders of Kamujina Company Limited are concerned with the future of the company in light of the new development in the sector and across the operating market. They have requested you to analyze the past performance of the company in order to assess its readiness vis-a-vis the growing changes in the sector. The management of KCL has provided you with the following recent information about the company. So we have this, our profit and loss, we have the financial position, and we have this other information. The shareholders have further noted that KCL might have an urgency problem. So it is about urgency problem, and that the current management may need motivation to avoid potential corporate governance failure, which is likely to aggravate the financial and operational situation of KCL. Yes. Please, Bukuru, look at your microphone. The members are hearing. So now, if what is required in part A, based on relevant calculation of ratios and the trend, it means we are doing a trend analysis. Evaluate the performance of KCL over the last 2 years. Consider the current ratio. Those are the ratios they want us to look at. So we are looking at assessing the financial. That's the title that I'm putting here. Assessing the financial performance or financial health of KCL. And based on the question that they have told us, they want us, the ratios they want, these are the ratios. They want us to give them the current ratio. I'm going to abbreviate the current ratio. They want us to calculate under liquidity. So this is liquidity. The first part is liquidity. Sorry, liquidity. In liquidity, they want us to get the current ratio. Then, if we go to under liquidity ratio, then under gearing, they want us to get the debt to equity and the interest cover. they want us to get 3 ratios. This is the liquidity. Maybe I can underline it like that. Then in gearing, they want us 3 ratios: debt to equity, they want in gearing again, and then interest cover. I don't know what gearing they want. That's the challenge. The interest cover. These are the ratios under gearing they want. Now, if you go down under investment, I think under investment, they want us to get the EPS, the dividend per share, and the dividend cover under investment. So we are analyzing 3 types of ratios. So when we go to investment, they want us to look at EPS. They want us to look at DPS, and they want us to look at dividend cover. Okay. Now these are the ratios that they want us to calculate. That's how we should summarize your approach. So you'll have a simple table where you're going to do your calculations. Now, the second column, in the second column, I'm going to have the workings. What are the workings? I mean the formula the formula to calculate these ratios. Then the third column, because it is a trend analysis, I'm looking at the year, which is 2020, 2019. So this will be 2020, and this is going to be 2019. So that will be my approach to this question, if I'm doing it. Now, the first, if I'm starting, it is current ratio. We know the formula that we need to calculate the current ratio. Current ratio over the current assets divided by the current liabilities. So what do we have? Then I can check my financial position. What do you have as current ratio? So we have the total non-current assets. Then we have the current assets, which we have cash and cash equivalents, and then we have other current assets. Then it can give us the total current assets, which will be how much? 251 plus 696 800. So this is the current ratio. Then what is current assets? What is our current liabilities? If I can check in it is given. The amount of current liability I see it is given. It is for the current year. It is 110.
Sanzimana yatwibye screen.
Yagenze gute?
Sinzi ibintu arimo rwose gupresenting.
Alala. None ashaka gukora iki Sanzimana? Are you seeing the screen? I'm not. Are you seeing my screen now? $0.94. Please.
So can you share your screen?
Sure.
Okay. I think it's okay now.
Now it's fine.
So this is going to be 109 for 967. I think that's the current. Now, once you have, I think, can I just calculate them here, or I just put them the total here? Because this is the current assets, this is the current liabilities in this current year. Maybe, yes? Yes, please. Hello? I'm seeing someone who's, I was hearing someone knocking. It is, if I can take it. Please, you are the one going to use your calculator to give me the figures. 911,800.
Excuse me, sir.
Yes, please.
Which question is this?
It is a question of August. Is it August? December 2021, question number 3.
Thank you.
Yes. Ten 09 1967. 1009 1967. Please tell me the answer from your calculator, because mine is it may not, because I'm not using a formula. Yes, I'm hearing. What are you getting here?
For me, I get times 100.
No, it is a ratio. It's in times.
For me, I get 0.83.
0.83. Yes, please. Okay. Then 2019, our current assets. In 2019, we have 48, 490 plus 689, 832. And the current liabilities were 1715, 959. So 683, 638, 332. 683 332 divided by 171. What are you getting? Remember, let's not waste time because me, I cannot use the calculator here, my Excel.
It is 0.55.
Hope I have not left the sheet. We are almost losing the sheet. Now, if you go to the gearing ratios,
But for me, I get 0.39.
I don't know now who is correct. Oh, I copied wrong data. Did I copy the correct data? Yeah, I copied wrong data. Sorry, it is 938, not 638. No, 938. I'm the one who copied wrong data, I think, here. 938. I don't know if the answer remained the same.
Yeah, it remains the same.
Okay. Now, if you go to the gearing, we are measuring three ratios. We are measuring the debt to equity, gearing, and then the interest cover. So if you look at our debt to equity, it is, as we know, it is debt divided by move out and then enter. And you are not getting him. I don't know now what is wrong with your network, your volume. Can you do it? So if you look at the debt to equity, so if you go to our, we have the non-current, we have the current. And if you look at our question, I don't know that that's what they want to mean here. If you look at the question, the shareholders have further noted that might have urgency problem. The problem is, if I check my title here, so they want us to get the debt to equity. And our interest, I think we are looking at the gearing part. What is our total equity? We have our total equity. We have 8. Maybe I would have reduced 3 zeros. 80 million. Oh, I didn't even. I have 8 plus the reserve, which is 1,123,654. And what is our non-current liabilities? It is 2,100,530. So we can take this 9. It will be 9, 123, 654, 684 divided by and you get what here? Members, you are taking a lot of time, eh?
4.34.
4.3.
It is 4?
0.3.
Now, if I go to what is our equity in this year? Is 8 plus 421, 481. This is 2058, 519.
Hello, excuse me.
Yes, please.
The formula for finding debt to equity, it is debt over equity.
Yes.
Then there we are using the equity over debt.
Hey, sorry, we have done the reverse here.
Yeah.
Okay, it's debt over equity.
Yes.
Ooh. I don't know how now I can copy this one. It cannot copy. So, so the answer is changing, eh?
Yeah, it is 2.3.
2
It should be in terms of 0.
can be 0 point something. Members, you are taking time.
It is 0.23.
Or 23%.
Okay.
So this one is 205. And if I can copy this, can I not take the final answer? Yes? Members, can I only take the final answers? Eh?
No, it's not good. It's better to take the whole figure where you got a number divided by another one.
Okay. 8, 14. For this year.
0.24.
Now, my issue is on gearing, because if I check in the question is asking us to calculate gearing. And which type of gearing? They have not given us the market value. And are we calculating because that's where the challenge I'm facing with this. Let me see. Maybe we can use this. Maybe we calculate a financial gearing using the EPS, using this one. Are you getting my issue? The question is requiring us to get the gearing. And how do you get the gearing? It is MV, market value of debt, divided by market value of equity plus market value of debt. But if you look in the data that we have, we don't have these market values, but what we have is the book value. I don't know if you are following, you are getting what I'm saying. Members, you are not giving an answer.
Yeah, we agree with you.
But we don't have the market values. But in the question, they want us to get the gearing.
Have the book value.
Huh?
You can use your book value, I think.
We use the book values.
Or
we are using, that's where now challenge. Or we are using EBIT over EBT to get the degree of financial gearing. Because that data we have it. But it's a bit vague here. So we are going to use the book value of equity. And we have this one in 2020. We have this. This is our equity. This one is not traded, so we are looking at 8. And then that's the I don't know if you are getting me in this. This is our equity, the book value of equity. And this is the book value of equity plus debt, because this is our debt. Will you follow it?
for previous year, comparative period.
Yes, that is for 2019. So it means our gearing will be
How did you get that 8,421,000?
no. This one I'm not taking it. I'm only taking this, which is here, and I'm taking this one. This is our MVD. This is my MVE. This is MVD plus MVD. Are you there?
Yes.
So can we just take it, because It should be for this part.
But are we required to calculate the gearing ratio?
You look at the question. They asked us 3 ratios. Look at the question. What they asked at. Maybe I'm the one interpreting it wrongly. If you look at the question, they want us to calculate the debt to equity, the interest, the gearing, and the interest cover.
Okay.
So which gearing are they talking about? Operating gearing, financial gearing?
There's no precision.
Eh?
They did not clarify.
It's not clarified.
Hmm.
So it either way, for me, I would say would even calculate the other EBIT over EBT. Because there is no precision in this part. I can calculate a financial gearing, or I can calculate a gearing ratio. Maybe they want a gearing ratio where I have to get the market value of debt over market value of debt plus the market value of equity. But we don't have market values.
So the answer on that is 25%.
20?
25%.
Yeah. So that is the other one. If you use this one, this is for 2020. Maybe I can put them here. This is 2019. And the 2020, our MVD is 2020. MVD is 21,530. That's the MVD. Our equity is still the same, 8. And the plus will be this plus this, which is almost the so what do you get if you apply the same formula? See this divided by. Now for me, let me tell you, my friends, to be on a safer side, I would calculate even the EBIT. I would have calculated even the financial gearing ratio, or the degree of financial gearing, because the question is asking us financial gearing. We don't know. They ask us gearing. Which type of gearing? Is it an operating gearing? Is it a financial gearing? Because we looked at 2 types of gearing in our previous part. So is it a financial gearing we are looking at, or are we looking at an operating gearing? Do we need a gearing ratio? Probably then you can look at that. Now, you can also calculate the financial gearing using EBIT over EBT, because we have this data. You have the EBIT, which is this, and you have the EBT, which is this. So you can also calculate the financial gearing from this. But we are going to calculate the interest cover from EBIT divided by interest expense, by the interest. So we can take our data here, our This is the operating profit. 1675,520 divided by 361. What do you get here? Let's move fast, members.
You're not seeing the interest.
Huh?
You're not seeing interest.
It is 361,000.
Now it will be
Me, I get 4.6.
Times, eh?
4.6.
Remember it is in times, eh?
Yes.
And here, 17,45,090 divided by 375. And you get?
We get 6.7.
Then another ratio we are calculating is the EPS. And how do you get EPS?
We did not calculate the financial gearing.
The financial gearing?
Yes.
Maybe because you can put it here.
Okay.
The question did not tell us which type of gearing. They told us to calculate gearing, but did not specify the type of gearing we are supposed to calculate. Maybe we can put it down. If you're calculating maybe our financial gearing, you can have we can have our EBIT divided by EBT. So you can now put it, this is 2019. Or you can still calculate the operating gearing because the question did not tell us the type of gearing they want us to calculate. But since they want to look at the change in the operation, you can also calculate the operating gearing. Operating gearing, which is our contribution divided by EBIT. Because we are not given the type of gearing they want us to look at. So to be on safe side, if you want to be on the safe side, you rather give the examiner the whole information and then he chooses what he wants. So what will be our financial gearing? If you look at the financial gearing, looking at EBIT, we already have the EBIT, which is this. Maybe I can copy the whole of this and the change. When you calculate it?
No.
So what is our, we need to change this and then replace it with our, it is 920. So profit before.
But that is before tax.
Before tax.
But now we should take the
It
one.
is here. 1,314 520. This is the profit before tax. The EBT. 1,314 13 14 520. 13 14 520. And you get what? Members, let's move fast.
$1.27.
1.27. That's around 27%.
Yeah.
Okay, then 2020. Let's copy the other data here. Today my Excel is not performing because I don't have where to write. That's why we are moving very slow. We are changing this. And we are taking 1370,090. And you get?
The same.
The same?
Yeah. 1.27.
Okay. So there is no increase, eh? Okay.
There is a small.
So if you look at operating gearing, you have already your EBIT. I think it is which one? Is it this one? We need the contribution. What's the contribution? Our gross profit is here. Look at 2363 110. $23.63 110 divided by EBIT. This is the EBIT is which one? This is this one. 1675 20. Okay, you can now move on. I think we will put on the last one. Now, let's come to this one, EPS. How do you get the EPS? It is our EAT divided by the number of shares. So, do we have our profit after taxes? It is here. And what's the number of shares? If you check here in the question, each share is selling at 1,000. Are you seeing it?
Yes.
Each share is selling at 1,000. It means how many shares do you have? 8,000.
8,000.
80,000.
So it means our EAT here, I'll have 920, 164 divided by 8,000. And I get what?
How you want?
You get 15.
1.15.
No, 115.
Then the second year, I mean the other year, it is 959, 063 divided by 8. $119.8.9. So we make it 120.
Yes.
Dividend per share. So you have your dividends. Divided by the number of shares. So our dividend is given in the first year. It is 230.
Where is it?
It's down here. 235. 235 divided by 8.
29.4.
29.4.
Eh?
And here it is 4, 1, 0.27 divided by 8.
51.4.
1.4. And how to get a dividend?
Excuse me.
Yes.
Where is this 4 coming from?
Which 4?
4, 11 to 0.27.
Hey,
Okay.
no, where am I? I've copied wrong data. It is 256,890. Sorry.
Yeah.
256,890. I copied wrong data. 256,890. Yes. This one is changing.
It is 32.1.
Okay. Now, how do you get the dividend cover? It is EPS, isn't it? Divided by the DPS. Isn't it? So it's going to be 115 divided by 29.4. And you get
We get 3.9.
and here it is.
Is it the in times?
Yeah, it is in terms. 120 divided by 32.1.
It's 3.7.
Now we have finished the calculation, but what is required? Are we only stopping here? What is the question? Our question, based on the relevant calculations and the trend, evaluate the performance. Evaluate the performance. So then after this, I'm going to write a report, maybe to the managers, to the board. Maybe I'm now writing a report from Director of Finance or Director of Finance to the board, to Board of Directors. The question, the title is the evaluation. Evaluation.
Where do you get that from? Because they did not ask us to write a memo.
No, right. Look at this question. Look at the sentence.
It is a report.
Evaluate the performance based on relevant calculation. Evaluate the performance. So these calculations help you to evaluate the performance. So it means you are supposed to write a report from those calculations.
What if I interpret those ratios?
How?
I just put another column in front of each ratio calculated.
You can score some marks, but that's not profession.
Okay.
Yeah. Evaluation of performance. Of KCL. I think that is a so then I'll have my first part is going to be the introduction. That's the first paragraph. It's going to talk about the introduction. Very brief. I don't need to write too much. Very brief. I write an introduction. And my introduction is going to be this report or this evaluation report. Evaluation report is based on 3 major categories. Of ratios, which are liquidity, gearing, and investment. That's a simple introduction to my report. Then the second paragraph, I'm going to talk about the liquidity position. Liquidity position. So, basing on the current ratio, calculated above, the liquidity position of the company is bad, and it has deteriorated Yeah? If you look at our current ratio, although it is bad since it is below 1. Below 1. Although there is some improvement, in the liquidity position, which is indicated by an increase from 0.55 to 0.83, but in general, the company is still facing liquidity challenges. So I can still just, because it is a trend, I can still just write that based on the trend analysis, there is an improvement in the liquidity position, but still the company is facing challenges because the current ratio is below 1. So I've seen the trend. There is because the question calls us based on the trend, there is an increase in the liquidity position, or there is an improvement in the liquidity position, but in general, we are still operating below because we cannot meet our current obligations using the current assets. So that's the liquidity position. Now, if we go to the gearing, that's going to be my second paragraph.
Excuse sir.
Yes, please.
I would like more clarification about the liquidity ratios. It means that every ratio under liquidity, it is compared based on the ratio above 1. It means that company is working good, but below 1.
Below, yeah. If you are calculating a current ratio, it should be above 1. If
benchmark is 1.
The benchmark should be, they said 2 to 1, but we shall talk about that in working capital. But if it is below 1, it means you cannot pay your current obligations.
Is it applicable on current ratio only, or it's under or the liquidity ratios?
When you are, no, each ratio is interpreted differently. Maybe did you attend our last class?
Yes, sir.
Yeah, each ratio is interpreted differently.
Yes.
It depends on what, because in the liquidity, we want to see whether our current assets can pay our current liabilities.
Yes.
So if it is below 1, it means you cannot pay.
Okay.
And therefore you are not liquid.
Okay. Understood.
Now, if you look at the gearing ratios, that's the number 2. My second part to analyze. Gearing ratio. Because, so our gearing ratio was measured by 3 ratios, isn't it? The gearing ratio, the gearing position was measured using 3 ratios. So the trend analysis, if you look at the first ratio we calculated was the debt to equity. The debt to equity. And we realized that what is our debt to equity? It is here. The debt is only 20% of the total equity. Or our equity. Is there an improvement? Let's see. We were 20.5, now we are 20.8. So the debt to equity, it shows an increase in the gearing, but the company the debt to equity show an increase in the gearing from 20.5, I think, percent to 0.8, which, but the company has a better gearing position as it finances its operations using more equity. Or the company can pay its obligations using equity.
Are you basing only on trend? Or
because what we are analyzing is a trend. The question asks us to analyze a trend. That's what they told us. We are analyzing a trend.
And then we conclude that the gearing position is good.
Because we have more equity than debt.
On which basis? This is what I'm asking.
If you look at this ratio,
yes.
What is the proportion of debt to equity? 20% is debt. For example, here in 2019.
Yes.
20%
is debt.
Is debt. It means 79.5 is equity.
Yes.
But we have increased our debt because there is an increase in the gearing. But
yes.
Still the position is good because we are financing our activities more with the equity.
If we have found like 49.8.
If we have found like 49.8 as a
yes. As a gearing.
As it means still you are still below. Maybe if we say you have 60 and 40.
From where do we qualify it as a
the business is geared.
High gearing.
The moment you're exceeding 50, I think you are.
Okay.
Highly geared, sorry. But here the gearing is still low because if you look at that. Now, if you look at the second ratio, because we analyze 3 ratios.
Yes.
If you look at the second ratio, which is I hope I didn't I copied I think I copied a different one. I copied the gearing one. Oh, not the debt to equity. Maybe you will change that. I copied this gearing in my thing. Maybe I can go to the interest cover. So the interest cover. The interest cover indicated this way in the number of times. In the number of times the operating profit can pay the interest costs. This is due to an increase in the debt or in the gearing. So if we go to this one, if you go to the EBIT, I mean the interest cover, we had 6.7 and we have 4.6. The position is good. You can say that the position is good because it means you can pay here 6-7 times your interest from the profit you generate. But if you check in 2020, there is a decrease. And what has caused this decrease is the increase in the level of gearing. It's what has caused it. That's what has caused an increase in the interest cover. But the position is still okay. I don't know if you are getting each other. Then another ratio we are going to analyze. I'm not going to analyze this. Then I'm going to look at the investment ratio. Or investment ratios. What do they look at? The value of the company.
Excuse me.
Yes, please.
Debt to equity ratio is not explained. Debt to equity.
Debt to equity is not explained. What we looked at is the gearing.
Yes.
The general level of gearing.
Can you comment on it?
Because that's what I copied. But still, we still have the same position. If you look at it, we still have the same position. Look at this. In 2019, sorry, our debt to equity was 0.24, meaning that was, because this is debt to equity, that was 24%, equity is 76. When you come here in 2020, debt is 23%, and the equity is 77%. What has caused that? So there is a decrease in the proportional. So the company made enough profit. Let me check here. I think there is an increase in the reserves that has made that decrease. Now, if you check your retained earnings, Tender reserves. Yeah, I think there is a very high increase in the reserves. It's not that has changed this. I don't know if you are getting me. So the position, it means the company is not highly geared. So since it is not highly geared, because they want to introduce into a new business venture, that's what you are analyzing. The company want to introduce a new business venture, so you are supposed to give them advice basing on these ratios you are calculating. Liquidity, they are badly off. If you look at the liquidity position, they are badly off. If you look at the investment, if you look at the gearing, the company is okay. It can issue more debt. It's not bad. It can still finance its operation using debt because the current proportion of debt is low. So they can still issue more debt. Now, if you go to investment, if you look at the EPS, there is a decrease in the EPS. There is a decrease in the dividend per share, but there is an increase in the dividend cover. So what has made a decrease in the EPS? I don't think this data is even making a sense. Let me see here. Let me see up here. As if the data is not making a sense. Yeah, the data is not making good sense, because if you look at this profit, the profit indicates a decrease. These data are not making good sense, but that's how we should interpret them. If you look at this one, if the profit has decreased, then how do you expect what has made the decrease in the profit? There is let's see the finance cost. Even the finance cost has decreased, and there is an increase in debt. The data are not matching with our interpretation. I don't know, but we can look at it in the normal way. But the data are not matching it what we want to interpret, because it's not giving a good sense. A lot of contradictions. So the investment ratios were used to assess the value or the attractiveness. The value.
The investment ratios.
Attractiveness of the company at marketplace. EPS and DPS indicated a decrease as compared to the previous year. But the dividend cover indicated an increase from 3.3.9 3.7 to 3.9. 3.7 to 3.9, which indicates a high capacity to pay dividends. So that is making the company, it's the company, although there is a decrease in there's a decrease in the EPS and the DPS, but there is an increase in the dividend cover that can attract more investors. So except the liquidity position, that's my conclusion. Except the liquidity position, that's the conclusion I'm making. Except for the liquidity position, that is not good. The general financial health of the company is sounding. So that's what I can conclude. But and I think that is one also the weakness in financial analysis. It is very hard that two analysts can write the same words, but they can still have almost the same idea, but it's very hard that they are going to write the same word. So my advice here is what? When you are carrying out this, like for example, you are doing a trend analysis, even if we just comment on the trend only and don't go into deep to make more interpret that this means this means this, but just say there is an increase in the performance or there is a decrease in the performance as compared to the previous year, because what you are doing out was a trend analysis. So members, there are other questions here, but I want us to look at this one. This one you look at it, which is 2023, question 1. You look at it, but I want you to look at this one. This one you can also look at it. 2023, question 3. I think this is November, but I want you to look at this August 2021, question 1. You see this question, you are carrying a trend. If you look at this question, you are carrying out a trend, but also you have industrial ratios. I don't know if you are getting me. You are carrying out a trend, but also having industrial ratios. It means when you are calculating, your calculation should be based on these ratios. For example, if you are analyzing this, for liquidity, you only take 3 ratios. You're going to take a quick and current ratio. If you go to activity, you're going to take inventory turnover, average execution period, and fixed asset turnover, and total asset turnover. When you go to profitability, you are going to take net income to net worth, that's to net asset, net profit margin on sales. when you go to investment, you will take the PE. When you go to gearing, you're going to take the debt to equity. That's how you're going to analyze your ratios. So when you are calculating, or when you are calculating, you will have the current year, the current year, the years, and then you put another column which indicates the industrial ratios. And your interpretation, now you are going to be interpreting a trend, but in relation to the industry.
Excuse me.
Yes.
Are we going to calculate based on those industrial ratios, or just it is for interpretation, reference for interpretation?
It means what you interpret should be also related to the industry.
But I think it's not about calculation.
You are not going to go beyond those ratios. You should focus on those ratios that you are having there.
Just for interpretation.
No, even when you are calculating, that's what you should look at. If I'm going to liquidity, if I'm analyzing liquidity,
you will pick those.
I'm only going to look at two. I'm going to look at the quick ratio,
and current ratio.
If I go to activity, I'm going to take the inventory turnover, the correction period, the fixed asset turnover, and the total asset turnover.
Yes.
If I go to profitability, I'm taking these two, net income to net worth, and I'm taking the net profit margin.
What is that ratio about? Net income to net worth means
you are going
what?
to look at the net assets.
Oh.
Yes.
But that is equivalent to return on
asset. But you are looking at it on the net asset, not the total asset. Yes.
Okay.
Now, if you go to the net profit, if you go to market, you're going to analyze the PE, you're going to analyze only the PE. If you go to gearing, you're only analyzing debt to equity. I don't know if you have a question on that part. Members, this is a very common area. Please look at the question the way it is answered, and try to answer this question. And I was emphasizing that in your analysis of these ones, for example, this one, you are going to do a trend of 3 years because it's a trend of 3 years. But when you are interpreting, you should also relate to industry. If I say there is an increase in the current ratio, but then I need to say whether that increase in the current ratio is below the industry or is above the industry. Tulikumvikana?
Yes, we do.
Yeah. So, members, we can talk about, as far as this ratio is concerned, you can look at the limitation of the ratio, like historical manipulation, different interpretations. Those are some of the weaknesses of using ratios. So I think we can now move on, and I want us to touch another chapter today. If you don't have a question on this one.
How about that limitations?
That's what I told you, limitation of ratios. Number one, we said historical figures, because most figures that we use in ratios, they are based on historical data. So you are showing what has already happened. You cannot show what can happen, but we are showing what has already happened. Another second limitation is manipulation. Because we are using accounting data in ratio. So accounting data is subject to manipulation. The third one is interpretation differences. That two people cannot have may have the same conclusion, but may look at the ratios differently, or may have different way of approaching. Have the same words. So there are a lot of differences in the interpretation of the ratios. So that is what we can talk about in this part. I don't know whether any question on that. Please, this is a common area, and I'm going to show these calculations. Please calculate them. Look at the formulas we used, look at that, and look at the question. If the question is say calculate, it is about calculating. But if say evaluate the performance using the ratios, evaluate, it means you are supposed to write a simple report. Or assess the performance, it means you are supposed to write a simple report. But if say calculate the ratios, you are not writing a report. So look at the verb used in the question. Or advise on the performance using ratios. It means you are supposed to write a report. So I am going to introduce another chapter, which is going to be our chapter number 3, I think now. Those whom have been together for this. Which is going to be cost of capital. Which is going to be cost of capital. I don't want to say this is very different from what you have looked at in your managerial finance. It's almost the same. It's almost the same cost of capital. It's maybe if we go deeper to that, but it covers the same items that you have looked at in your managerial finance. So it's not going to. So now, what is the cost of capital? When you invest in a business, you are expecting to generate
muri kumva mwarimura
Oya.
Kwijwi rye ryize ubwo ashobora kuba agize ikibazo cya communication.
mubwire ko tutamwumva. Ndabona none wagiye.
Felix amakuru. Ni meza. Dr. Daniel se n'ubwo ibyo yigisha wenda bikura mu mutwe. Hanyuma working examples cyangwa questions agakoresha past paper. Ntiyaduha notes ziririsha ukuntu umuntu akanirwariza. Kuko njyewe uko ndeba iyi summary yiwe umuntu arirayinzaho gusa byarangira ntacyo abonye ari ukwikorera past papers gusa. Ibi nari nkubaje twagira ngo tubivuganeho wenda atanari sinzi kuko notes turazikeneye kugira ngo na chapter ninarangira umuntu arebe contents nyayo muri iyo chapter kugira ngo atazagira udusiga.
aragira ngo amenye
ariko note zirahari. Note ziriya za Equipare zihari kuri website se.
bukuru
No kuvuga ngo nuko nyine yenda iri somo riri trick ariko izo note ari kuvuga ntabwo niyo yanazigura. Note za Daniel ntabwo ziba ziri updated kandi namwe murabizi. Arazigira ariko ntabwo ziba ziri updated, zirimo n'amahera menshi batayipinga agashyiramo utuyera. Ubwo rero njyewe nakugira inama yuko wafata ziriya notes za Equipare ugafata n'izi summary za Daniel.
Bivuga ko yari weakness rero
kabisa kubijyanye na note. Iyo ni weakness kandi ntabwo wayikosora uyu munsi. Segera imbere bari kudutuburira ni ibikira.
Yumiwe niyo weakness.
Where did I disappear from?
From
You are the
the
one who knows.
introduction of chapter 3.
From the chapter 3 cost of capital.
Cost of capital.
impapuro za kiriza ari gukubita ziramukanze.
Umugabo se yaciyeho nanone.
Kwari kugeza saa 11 se.
Cost of capital.
Ako yo sake ni yandi yabitse gatatu Petero yatari yakana Yesura.
We are listening from teacher.
Okay. So what we are talking about is cost of capital, and we are saying that cost of capital, it is the return that you should generate from the sources of finance that you are using if you are to pay the owners of those sources. So it means it's the cost of that you are supposed to pay to the owners of the sources of finance that you are using. And we have looked at the importance. Where do we apply cost of capital in the finance theory? Evaluating investment, you apply cost of capital as a discounting factor. Evaluating performance, most especially when we are computing the economic value added, we use the cost of capital. When we are valuing business, we also use cost of capital. So another thing that we have talked about, we are looking at how to compute this cost of capital. How do we compute the cost of capital? And I was saying the computation of the cost of capital depends on the sources of finance that you have. And we have got different sources, but we categorized the sources into 4 major sources. That is equity, what we have called as common stock, preference shares, debt, and then the retained earnings. And I said retained earnings in most cases is combined with common stock because they are all equity capital. Now, we were looking at how to compute the cost of capital. So we are first looking at the cost of common stock. And
Excuse me.
yes, please.
What is I think there is one word or one sentence in the first paragraph. Keep the value of unchanged.
The value of farm.
Okay.
Okay.
Njye nashaka umfashe umbwire cost of capital mu Kinyarwanda ni iki?
Cost of capital. Cost of capital mu Kinyarwanda ni navuga n'iki se mu Kinyarwanda? Ni igiciro wishura abana bakwaye amafaranga. Ni byose nicyo Kinyarwanda se mvuze nicyo.
Oh yeah.
None se tuvuga urugero, reka tuvuga urugero. Wafashe nguzanyo muri bank. Igiciro giye kwishura ku nguzanyo ni iki? Serial interest?
Yes.
Interest, yes.
Si yose?
Reka mufashe kumusobanurira. No kuvuga cost of capital. Capital bukoresha uburyo butandukanye, hari capital y'amashares z'abashaka, hari n'amafaranga waragurije kuri ba finance holders nka bond nk'ama loan. Buri type of capital urimo gukoresha bifite cost yayo. No kuvuga kuri shareholder
abariho cost yayo niyo yashaka kumenyera ijambo. Cost yayo ni igiciro, ikiguzi. Yeah. That's the best word, ikiguzi.
Ikiguzi kubera ko company kuri company ni ikiguzi kuri yo nicyo bisaba kugira ngo ibashe kubona ayo mafaranga cyangwa se yakoresha
yego
ni ikiguzi kuri yo
So we are looking at this common stock. Common stock, those are the share, ordinary share capital. And we are saying, as far as the ordinary share capital is concerned, what do you pay the ordinary shareholders? To be sure?
Dividend.
Dividend. We pay them dividend. So it means the cost of the ordinary shareholders will depend to the dividend or Kubishura. Yes.
Yes.
And what is the cost? That's the price they are expected to buy the shares. So that's why because we are saying when it comes to cost, how to compute the cost of the common shares, we have got two models. To the dividend model, the collection dividends, to the asset pricing model, which we are going to look at. So, for the dividend model, it is going to depend on the dividend. So, what we are relating is the dividend you pay the shareholders is the price the shareholders are buying the shares. Please, you can mute a bit. Now, so our first equation, we said the cost of common stock will be the dividend divided by the price per share. You get that. Now, we know that we pay dividend from the earnings. When you are paying dividend, you pay dividend from the earnings. So meaning that as your earnings are growing, your dividend will grow in the same direction. So as the earnings, that's what I was writing. As the earnings are growing, dividend distributed to the owners will grow in the same direction. Will grow in the same direction. As your earnings are growing, even the dividends are going to grow in the same direction. So what brings that to this case? It means our shareholders are going to expect to buy shares based on the expected dividend growth. So in this case, our KE will be equal to D1 I divide by PO, then here I add the G. I'm now recognizing the growth rate where D1 is the expected dividend, which is equal to D0 or D0 into 1 plus G. G is the growth rate in the dividends or in the earnings. And P, we have already talked about it. Or D0 is the current dividends. So that is how you are going to determine your cost. That because we are expecting our dividend to grow. So what you need to determine is the expected dividend. If I have a dividend now, what dividend will I get next year? So the dividend I'm going to get next year will determine the cost of that I should charge today.
Excuse me, lecturer. What is the logic? Mathematically, you can see it and maybe compute it, but what is the logic of dividing by PO, price of
the current price?
share? Yeah.
Because what we are saying, what are you getting? What you are gaining is the dividend.
Yes.
What do you pay to get the dividend is the price. So if I want to get a return, it means it's going to be the gain divided by the cost that I paid. Then I get the return. Or what called the yield.
Can you come again?
We say, remember in my sentence there, I said, for the shareholders to buy shares, they are going to look at the dividend they expect to get.
Yes.
Okay? So it means the return of the shareholders is going to depend on the dividend and the price.
The price which is cost.
Which is cost. So for example, if I'm expecting, this is what I got. I got 80 as a dividend, but I paid 200. So what is my return?
You pay 200 to who?
To buy the shares.
Oh, okay.
And I got 80. So what return on my investment did I get?
Okay.
You get it?
Yes.
Yeah, that's going to be your return on your investment. So now that is how you are going to compute your cost of equity when you have these ordinary shares. But some time or some part you may have what called flotation costs. Flotation costs. And what are flotation costs? Flotation costs, these are costs. These are costs incurred when
Can you scroll up and hit up to dividend model? Yes.
Can you move? These are costs incurred when new shares are floated or issued. When the company issue new shares, the cost incurred to issue new shares is what called flotation cost. They include underwriting. Underwriting fees. And the brokerage fees. So when you issue new shares, in most cases, it's not the company that sells the shares. If you look at these companies, for example, even when the government has issued a bond, it's going to issue a bond from the bank. So it means the banks are underwriters. If companies issue shares, they issue them through the banks. So the banks are going to be underwriters. So they take the shares, they take the responsibility to sell the shares. So it means they charge a cost. And the cost they charge is what's called a flotation cost. So that cost reduces what the owner is going to get. So if I want to determine the real price of the share, I will get what was paid, then minus the flotation costs. Then I will get the real price of the share. So the flotation costs have got an effect on the share price. Thus, KE under flotation cost will be equal to, I'm going to copy this. D1, we already know what D1 is, plus G over PO minus F. And we said where F is the flotation costs. So that is how you are going to compute your cost. So you'll get the price D over P minus F, then plus the growth. Remember, D is outside the bracket. Now, what are the weaknesses of the dividend model? Weakness. Weaknesses of the dividend model. Number one, we already said it ignores the capital gains. Remember, in the normal calculation, the return of the shareholders is composed of the capital gain and the dividend yield. But in the calculation of the cost, we assume that the only cost of the shareholders is the dividend we are going to pay. But when the shareholders are calculating their return, maybe if I can put, if you look at when you're calculating what's called the shareholders' return, it's composed of the dividend plus P1 minus P2 minus P0, maybe divided by P0. This is how you compute your capital gain. I mean your shareholders' return. But in the normal calculations, in our normal calculations, we have assumed that what the shareholders are only getting, or what the shareholders are only getting is the dividend. The capital gains are going to be ignored in the model, which is a weakness which may understate the cost of capital. Because the shareholders, for example, most especially, if you are looking at active shareholders or active investors, for a passive investor, this is okay. But for an active investor, is looking at both dividend and the capital gain. So in that case, it may not work on active investors. Hope we are there together. Number 2, it ignores risks associated with investment. So we always assume that there is no risk at all levels. All years, we don't have any risk. You are going to invest at 0 risk. So risks are ignored in the computation. And we know that the higher the risk, the higher the return. But in this case, risks are not considered in our computation. Number 3, the growth rate is subjective. The growth rate is subjective. Why do we say it is subjective? Because it assumes a positive growth only. It assumes a positive growth. We only assume that the growth is going to be increasing every year, which is not the case, because sometimes a business can make a loss and find that the growth rate is not the same as the previous year. We always assume that our growth rate is going to, we only have a positive growth. Every year we shall be getting profit. We are ignoring the losses that the business can get. So these are some of the weaknesses that accrues on the dividend model. So our next is the capital. That's number 2. Capital asset pricing model. I'm not going to enter much details into here because we are going to discuss this in a portfolio. We are going to discuss this one in a portfolio. So I'm not going to enter too much details into this CAPM. But this model assumes 2 types of risk. Or the model assumes 2.
The first model
was dividend model.
Okay.
2 types of risks, which are systematic risks and so we always assume that the business activities are affected by 2 types of risks. And these risks, we have the systematic risks and unsystematic risks. So what are these risks? Maybe if I talk about the first one, systematic, we shall discuss this one in the details. when we are discussing portfolio theory, systematic risks. So these are risks within the economy or the market which cannot be diversified by the firm. For example, interest rate, inflation, exchange rate, GDP, unemployment. In fact, what we are looking at here are the macroeconomic factors. So you cannot diversify them. It means you have to meet them. You cannot hedge them. You're going to meet them. You can hedge them, but you cannot diversify. So you have to consider them in your calculation. This is what we call the systematic risks. Now, number 2, we have what we call unsystematic. Unsystematic risks. So these are risks that are within the industry or the sector at which can be diversified by the firm, e.g., lack of skills, labor strike, etc. These ones can be diversified. Since because you can diversify them, this may not have an effect on the farm because you can easily diversify. If there are no lack of skills, you can look for people. You can look for people with good skills and they solve the problem. Labor strike, you can solve the problem of labor and the problem ends. So these ones, we assume that this is unsystematic. They don't affect the farm. So the one which affect the farm are the one that the one which cannot be diversified, which we call them the systematic risks. So when we are determining the cost, it means we only look at those ones which the farm cannot diversify, are the ones that are going to affect the farm's activities. So if we are using this, yes?
What is the meaning of SHR, under weakness of dividend model?
Shareholders return.
Yeah, okay.
So it means here we are having our risk-free rate plus a risk-free rate plus our beta. Into market return minus risk-free rate, where RFR is the risk-free rate. And the risk-free rate is a return on a risk-free asset. And what we consider to be risk-free asset, most government securities, we consider them to be risk-free. So if you have a return on a bond, a government bond, a return on these treasury bills, we consider them to be risk-free. Then our beta, it is the systematic risk. The systematic risks, and RM is the market risk. So market return. Market return. So that is how we get this. And please, when you are computing the cost of equity, it's going to depend on the data that you have. If you have a dividend, you're going to use the dividend model. If you have risk-free return on a risk-free asset, return on the market return, you have beta. In this case, you are going to use the capital asset pricing model. So it's going to depend on the data that you have in the question. That's going to determine which model are you going to use to determine the cost of equity. We shall discuss more capital asset pricing model when it comes to portfolio theory. But currently, maybe we can leave it at that point. Now, if I get RM, because sometimes it can be RM minus the risk-free rate, it is either what's called the risk premium, sometimes they call it, or the market premium. So if I get the return on the market minus a risk-free rate, what I get is what we call either risk premium or what we call a market premium. So if you are given a risk premium, you don't need to subtract anything. What you generally get is multiply by the beta and then rate to get the cost of equity. So as I've mentioned, we shall enter into more this when we are discussing portfolio theory. For this time being, we can stop it at this point. Now, another one we can talk about. Yes, please.
Excuse me. This second part of the formula, is it remuneration.
To invest in a risky asset.
Okay. That's why it is a factor of beta.
Yes.
Okay.
Maybe what I did not talk about, how do you compute the growth rate?
That means we are going back to growth model.
Yeah, it is something maybe I thought we should discuss, but let me talk about it here. But it can still be a very simple subtitle. How do you compute the growth rate? Now, there are two models which we use to compute the growth rate. You can use arithmetic, or you can use what called the growth model. So there are two methods. Used when computing the growth rate. That is the arithmetic or Gordon growth, Gordon's model. So when you want, because sometimes a question may not give you the growth rate, but you are given the data that you can use to determine the growth rate. So if you are using the growth rate, for example, if you are using the arithmetic, if I'm using the arithmetic, my growth rate, G, will be equal to, I don't know if I can use it. I'm going to use a simple one. I'm not going to cut it.
Nth root.
Yeah, but how do I do the nth root? Oh, I use an arrow. So it's going to be the nth root. So this will be my n into, I will say, if I say D0 divided by D1 or D, sometimes it's
It's dn over d0.
no, if I say dn over d0, because sometimes you may end up using the data differently. That's why sometimes it challenges me. Say dn over d0. dn is I'm going to define it as current dividend, and I've already defined the current dividend. So can I say the current dividend divided by D minus 1 like that? Will it make a sense? I make this one dt. Such that we don't change the terms we have been using, minus 1. Where D0 is the current dividend. And dt is the initial dividend. I then we can define it like that. Such that we don't change the meanings of the words we have been using. So that is how you can compute using the arithmetic. So in this case, you may be given, maybe you can be given
This means what?
This is the initial dividend. Let's say I have 2015. Let me see that. 2016, 2017, and 2018. Now I have my dividend per share. This is 10, 12, 14, and this is 17. And then in that case, what will be the growth rate in that case? What is the growth rate?
It is the summation.
Hey, oh yeah, growth rate.
Growth rate is the cubic root.
So it means our G will be, so if I say determine the growth rate in the dividend, determine the growth rate in the dividends, we are going to have
Cubic root.
Square root of 4. Is
square
it
root
of 4 or 5?
It is a cubic root, sir.
Yeah, it should be cubic root.
Where 3 it is
Because now this one is at the end of 2015. So you calculate 2016, 2017, and 2018. So it means our N.
Excuse me? Come again.
Our N is 3.
Why?
Because
How 5? Why not 4?
I'm explaining. This dividend 10 is at the end of year at the end of the year.
Sorry?
It is at the end of 2015, not at the beginning.
Mm-hmm.
So it means if you are calculating the growth rate, you are calculating from
2016.
2016, 2017, 2018.
Okay.
Yes.
Excuse me, sir.
Yes, please.
And we use the total number of years and the minus 1. N minus 1.
It is still okay. It still applies.
Okay.
Yeah. So it is. So it means I'm getting 17 divided by 10. Then what I get minus 1. Then I'm going to get the growth rate. And you get what?
For me, I got 2.9.
2.9. So if I get 17 divided by 10, 1.7. So 1.7. Power Is it true? Now I'm getting 19.
Yeah, it is
It's 19, sir.
0.19. Yeah, it is 19%.
19%, eh?
Yeah.
So it is 19%. So that's going to be the growth rate in the dividend.
Hello?
Yes, please.
You come back with 3.
How I got 3? So someone has also given us another way to do it. Get the number of years, then minus 1. That is one way. But the logic is the first year, because this dividend is at the end. At the end of 2015, we don't include 2015. We start from 2016, 2017, and 2018. Hope it's clear.
Very clear.
Okay, so then the another one is the Gordon's model.
Excuse me.
Yes, please.
How did you get 19? For me, I'm seeing different answer. I don't know.
You're getting what? Your calculator probably. What are you getting?
0.5.
How? Just what I got 17 divided by 10. Isn't it?
Yes.
1.7.
1.7. Then I get this, the cube root of this. So I get this power 1/3. Isn't the cube root? Then minus 1.
Maybe I don't know.
Huh?
Maybe I'm failing to use the calculator.
Check your calculator because it should be. You first deal with the one inside. 17 divided by 10. 17 divided by 10. Then after that you get the cube root.
You multiply by 100, eh?
Yeah, multiply by 100 after that because you are putting into percentage.
But for me, I'm seeing 19.3.
Yeah, is that true? 19.343.
Yes.
So the next one is what's called the Gordon's model. So now, if you use the Gordon's model to compute your growth rate, or Gordon's model growth rate, in this case, your G will be equal to B times R, where B is rentation rate, and R is return to reinvestment. Sometimes we say return on equity. If you don't have the data. So that is the growth rate, the Gordon's growth rate model. If I have the rentation rate and I have the return on equity or return on reinvestment, then I can determine the growth rate. Please be very keen with the. Be very keen. Be very keen with the with how to compute it, because sometimes you may not be given. You may be given the orientation. You have the return on equity, return on reinvestment. Then you can compute the growth rate based on this. And what is the orientation? It's going to depend on the dividend payout. If I have a payout, then I can be able to know how much was paid out and then how much is retained in the business.
Is it retention or it is retention?
Retention. Sorry. Retention rate, yes. So how much was paid as dividend, how much was retained? So the B is going to be the much which was retained in the business. If I can give an example, if my payout, if the payout is 40% or 50%, the payout is 40%, then it means my retention R will be 60%. So it means when I'm calculating, I will get this 60% which was retained times the return on equity or the return on reinvestment, depending on the data that you have. Is it clear, friends?
Yes.
So that is how we compute.
Is the return on reinvestment the same as the return on equity?
Sometimes if you don't have that, because you are looking at if I've retained the money, how much return am I going to get on it? Sometimes you may not be given it and you are given return on equity. Yeah.
But why do we use reinvestment, not investment?
Because we are looking at the money you retain in the business. How much does it generate as a return?
That means I've retained some money, then I reinvest it.
You are going to invest it. So in brief, that is how we compute the cost of equity. You should know how to play with different data. Probably when we meet again tomorrow, we shall look at an example on how to compute. I'll look for some questions on the computation of this part. So the next part, we are looking at cost of preference.
So before you go to the next part, it's meant in the exam, we are given we are requested to calculate the cost of equity, where we are given the retention rate or the return on investment. Then we know how to calculate the cost. Or we just given scenario
because
which require
in most cases you are going to use this under dividend model, that you have a dividend, you have a current dividend. Let's say, let me maybe give a simple scenario. Let me give a simple scenario that company X has just given a dividend of maybe 40 FRA per share. The company is expected to grow given rate. The rentation rate is 70%, and the return on reinvestment is 65%. The current market price of shares is 250 for a if you look at this one, how can you compute the cost of equity? So if you can get one way to pass finance is to get the data. If I have my data here, if I check my data, I'm being given the current dividend D0, which is
D0 is 250.
D0, the current dividend, which is 40.
It's 40.
Then I've just given a current market price.
250.
250. Is it okay? I've been given the rentation B, which
retention rate
65%. Is it okay?
Yes.
I've been given
R.
So it's 70.
It is it?
B, it's 70.
70, sorry. I think the intention is the one which is not correct. The return on investment, it says 15%, sorry. Okay. I've been given R as 15%. This is percent. But I don't have G. And you know, to be very clear on questions of finance, first look at your formula and see if the data you have can fit in your formula. It's okay? Is the data that you have, can it fit in your formula, or you need another data? So if I'm to get KE, because this one is a dividend model, it's D1 divided by CO plus G. So if you look at this, do you have complete data? No. We don't have a complete data to fit in this data. We still miss, we don't have D1. So how do I get D1? To get D1, we said it is D0.
Excuse me. Why is not D0?
Huh? We are looking at the dividend you are going to get, the expected dividend you are going to get, not the current dividend. Because this is at the end. So you are looking at the dividend you are going to get in the next year.
The next year or the current year?
No. The current year is what you have, what they have declared.
This is 40.
This is 40. So but what is going to be, what are you going to get in the next year?
Okay.
Because on the 40 you have not purchased, you don't get it.
On what?
The 40 dividend. If you are not yet a shareholder, you are not going to get that money unless if you are already a shareholder. Seriously?
But the company X has the shareholders.
Bariya bo ni bakachwetinga ariko ushaka kugura imigabane Unareba what has already been given or what they expect to give.
Okay.
Yes. So if I can check in my data, I don't have D1. So I need to get the D1. So I also, if I check in my data, I don't have G. I need to get it. But based on the data, I'm not going to use the arithmetic model. Automatically, I'm going to use the Gordon's model. So it means in this case, my G is going to be R, which is going to be 15% times 70%. And you get what? 10.5?
10.5%.
10.5%. So once I have this, I can now get my D1. So it means D1 now is going to be, because I already have the data to get D1, it's going to be my 40 into 1 plus 0.105. And I get D1 as what?
44.2.
44.2. So you see that I have all the data that I need to feed my formula. So once I have the data to feed my formula, then I can compute my KE, which is going to be 44.2
over 250
plus 0.105. Then I divide by 250. I don't know if you must have answered your question with this.
So we can consider that that the dividend payout is 40.
Yes.
According to the above explanation.
Yes, that's what they are paying out. That's what they are retaining.
Okay.
So what do you get as KE?
28.2%.
So it means this is the return, 28.2.
Yeah.
This is the return that you should generate on equity capital.
Sorry, excuse me.
Yes.
This is the return that you should generate
on equity capital.
on equity.
If you don't generate this return, you cannot be able to you cannot be able to convince shareholders to invest.
So it means this is the minimum.
That's the minimum they need. So we can move on. We have to finish the theoretical part. Then tomorrow we look at the calculations. So I think we can move on. I think, and now we are looking at the preference shares. And what is the preference shares? Please mute. Preference shares, these are, it's the minimum, the cost is the minimum return that you should get on the preference shares. So, and what do preference shares get in the business? Like ordinary shareholders, preference shareholders get a fixed dividend. Maybe that's the only difference. Them, their dividend is fixed. So because the dividend for preference is fixed, is not growing, it is perpetual. So what you are calculating a cost on a fixed dividend. There is no growth because they have a fixed dividend. So preference shareholders get a fixed dividend from their investment. That's a perpetual dividend. So therefore, there is no growth rate. There is no growth on fixed dividends. So fixed dividends, they don't grow, but because their argument is to have a fixed dividends. Because the dividend is fixed, the cost of preference shareholders, the KP for preference shareholders will be that fixed dividend they are going to get, then I divide by the price, where D is the fixed dividend. Another thing I've not talked about, dividends on preference shareholders or for preference shareholders. And PO is the current market price. Maybe what I've not talked about, maybe I can introduce this one. X div current market price. I introduce that word because even in the previous, I didn't talk about it. But when we are looking at PO, we look at PO as X div current market price. And what is X div? When did we say X dividend? That is very important in your computation. We are looking at X div price. So it is the price of share.
This is only applied here for
even up on preference. I mean on ordinary, it should be X div, not a chum div. It is the price of shares after the dividend has been paid. So if the company has already paid the dividend, because when the company announces that it's going to pay dividend, we expect that the price of the share is going to change in the same direction with the announcement, that the price of the share is going to increase.
Why?
Because when you announce that today this company has made a good profit and we are going to pay dividend to our shareholders, for shareholders who want to get dividend, they are going to run to the market to buy shares. So as they run to the market, remember the price is driven by the forces of demand and the supply. So the demand is going to be high and the supply will be limited and the share price will increase, reflecting the dividend that was declared. So what you should be very careful when you are reading this part is to identify whether you have an ex-div price or you have a cum div price. Cum div price, the price after announcing dividend or declaring dividend, the price of share after announcing pay dividend. That's what's called a cum div price. Please look at this even in common stock. Look at this, whether the price is cum or the price is an X. When you are computing the cost, you should compute it on the X div, not on the cum div price. It should be on the X div. So it means if I want to get an X div price, will be equal to the cum div minus dividend. Please, even when you are looking at common stock, look at that information. Whether you are having an X div price or you are having a cum div price. Otherwise, you may end up making a mistake. Please calculate the cost using an X div price, not cum div price. Because we're expecting that when you make an announcement, the price will change in the direction of the announcement of the dividend, if it is an efficient market. Maybe I can give you this one. You tell me a simple example, probably. On 31st December 2023, the board of directors, please, you are going to give the answer. The board of directors of company X announced to pay dividends of 20 due to preferential orders. The price of shares on 1st January 2024 was $150. Okay, tell me the answer. What do you have in the question as your data?
You have cum dividend.
You have a cum div.
Yes.
A cum div of 20. Isn't it?
Yes.
You have a price
Of 150.
of 150.
Mm.
So now you can be able to, because if you are to compute, computing the cost, the KP, because you said just put in and see if you have the data. Our KP is D over PO, but PO is an X div. It means I need to get an X div price. I need to get an X div price, which is going to be
150
150 minus 20
150
minus 20.
and I get 130.
130.
So once I have that, already I have my D. So it means I can get my KP as 20 over 130.
130.
And you get what?
$0.15.
Yes, 15%.
Yeah.
Okay. So members, I have to try. I'm in Musanza and I want to travel to Kigali, so I'm going to stop here.
Yeah, it's okay.
Give us a similar to
Saa munane twavuze.
Wakwita mu gitondo se mwari?
Mu gitondo mfite kirasi ya tax.
excuse me, scroll up.
Huh?
Can you scroll up?
Excuse sir.
Yes.
Try to clarify. For me, I think the cum div is 20.
Yeah.
So I thought we should take 20 and remove something to remain with X div, but you took 150 minus 20
To get the X div price.
Why can't we remove it from 20?
20 is the dividend.
But it's cum dividend.
Cum div price.
Yes.
It is a cum div price.
Okay.
Maybe this was a cum. Maybe this is a dividend. Sorry. Maybe that's the this is the cum div price. Cum div price. Yes.
Yes.
But yeah, I think now it makes sense. Eh?
Okay.
So I think I'm not going to share today's Excel because I've not completed this part. Maybe I'll share it tomorrow after completing cost of capital. I'm only going to share the question that we looked at. Isn't it?
Allow us to finish first. Copy the example. Yes. Stop.
I hope it's okay.
Have not yet finished. Not yet.
Njyewe ndi mu cyaro nshaka kugaruka mu mujyi.
Just a few minutes.
Musanze is not a charo, it is a secondary city to Kigali.
Urabizi Yesu yavuze ngo arabanza mu mujyi.
Yavuze ko azabanza mu mujyi not capital city.
Mu mujyi. Nose mu capital.
Umusoro wigisha none advanced.
Na advanced.
Mu mujyi ni na Musanze ni mu mujyi.
Oya tugomba kuba hariya mu mwuga mukuru tutegereje.
Okay.
So is it okay now?
1 minute.
Oh, is it okay, mister?
We are done.
Okay. I'm only putting this one into your into the group.